Jim, what happens if we do get a Greece debt deal?
Well, I mean, I think that Greece will be a good reason to sell off, and people will say, okay, that's done, and it will be a surprise that it sells off. This market's surprising constantly. I mean, it's held up well and rallied in the face of all the Greek morass. So it's reasonable to think that when Greece is resolved, the market goes down. I mean, everything's counterintuitive in 2012. So, I mean, it's counterintuitive that you would expect if we got a deal and Greece moved on, that we'd be fine. But they'll just go after another country. We were discussing Portugal beforehand. I mean, I want to keep something front and center. When you have a growing economy, like we have in the United States, then you can trade on yourself, on your own momentum. It's really easy to trade off of Europe when you have a declining economy. But when you have growth, I'm not saying growth conquers all, but I am saying that growth allows you to analyze individual companies that are doing well, and also breaks the linkage with the S&P. Because the macro, that risk on, risk off crap that like they perpetrate at the absolute top of that nonsense, they actually did an ETF. What happens is that you can analyze individual securities irrespective of Europe, and that's what I'm urging people to think about.
Do you think that's already happening, considering we've had a 33-day move and we still haven't had a big sell-off at this point?
I think that I've been comparing this market to the 80s and 90s. There's just not enough people around, frankly, who traded during the 80s. But in the 80s, you would have situations like Coke would be at 30, and then you'd hit it up again and be at 60, and then it would be at 90, and then it'd be at 120. And then you'd do a 3-for-1 split and say, well, how's that possible? And because there was a radical revaluation of companies. We could have a radical revaluation of companies finally versus the interest rates, because when you have interest rates this low, it pays to sell. I mean, like, you know, people should be taking down money to buy anything here because it's not going to last. But interest rates are so low that eventually people are going to realize that Coca-Cola is a better bet than the United States. And so I really want to urge people to realize that not that Europe's a sideshow, but when you have growth, you can put a lesser dampening on Europe. Like Italy, when it traded to 7% in November, that caused the Dow to go down 400. There have been things put in place to make it so that doesn't happen, and yet people don't seem to realize Italian bonds and Spanish bonds were the place to be. People just don't understand that because it's, again, counterintuitive. But I'm just urging people to analyze things on a stock-by-stock basis.
So when an investor is looking at the market and they have a lot of cash on the sidelines, they keep seeing this rally and they want to get in, or we see a short squeeze, do they go to the Cokes, or do they need to go a little bit more beta, like a cyclical? What's the better story?
They don't think like that anymore. That's wrong kind of thinking. They're going to think about what companies are doing what Wynn did today, Wyndham. Boosting the dividend, a big buyback. They're going to look at Time Warner versus Disney and going to say, okay, well, listen, what's the current earnings momentum of Disney? That kind of thinking that you just missed cyclical. I mean, I think what will happen is that when you're in a period where companies recognize that dividends are important, you have to say, are they going to go toward dividend stocks or not dividend stocks? And I think that you're going to have a healthy across the board move in a lot of stocks before we get to a level where we have to start thinking, is there not enough growth to sustain Caterpillar at 150?
Right, so it's going to be the dividend story still.
Yes,
continuing.
I think so.
All right, thanks, Jim.